Thank you everyone for coming. This is Kobad Bhavnagri from Bloomberg New Energy Finance. He's a very special guest today. He's also UNSW alumni. Kobad heads up a team of analysts at Bloomberg New Energy Finance. They specialise in transformation of the Australian energy sector. So it's not a finance company, it's more of a market analysis consultancy, and they work alongside the actual Bloomberg as well. Kobad's worked in finance and engineering since 2003, so he's also an engineer, and he specialises in energy economics, markets and policy. So please welcome Kobad today. And I'm sure you'll enjoy his talk. He gives many presentations throughout the local industry at all the events, so I'm sure you'll have fun. Thank you.
Thank you. Thank you very much, Linda, and thanks everyone for coming along. I know it's exam time, right? It's exam time? Yeah? So yeah, all the students out there, good on you for coming. But none of you are undergrads, right? You're all postgrads? Any undergrads in the room? You should be studying. So should you. No. Well, it's just going to be on the exam, is it? All right. Well, yeah, it's great to be here. So, as Linda said, I studied mechatronic engineering just up the path there at School of Mech Eng, and we didn't have lecture theatres quite as fancy and fabulous as this, or exciting guest speakers, of which I'll try to be one. So I'm here to talk to you really about a bit of a broad overview about the direction of the global energy system and sector. And as Linda said, we are an analysis house. So Bloomberg New Energy Finance is kind of like the IEA, but an independent, another version of the IEA. And actually the IEA subscribed to our work, so we help to give input into them. And we started in 2004 exclusively as a research and data house on the renewable energy market. And we've got about 200 people around the world. We're obviously part of the larger Bloomberg company, which is one of the world's leading actually provider of information and news to the financial community. And I head the team in Sydney, which is a team of 4, and we specialise on analysing the Australian market. So today I really want to talk to you about 3 main themes, which hopefully are the things you can walk away and take away with you today. The first is that the global energy system is rapidly changing, and that's due to a lot of the work that happens at these sorts of institutions and carries forth into the industry. And a future filled with renewables is now inevitable. And that's mainly due to economics, as I'll go into in some detail. However, from an emissions perspective, the change that is underway is not happening fast enough. And I'll caveat that with yet. Because history clearly shows us that we are terrible at predicting the future in general, and in particular in the energy sector over the last 10 years where things have been changing so rapidly, we've been particularly bad. And the history of many other industries as well shows that when you're in transition and things change fast, that people get it completely wrong. So if we first kind of just start off by saying, where are we? Where are we at and where have we come? So this is a chart which shows clean energy new build installations between 2001 and 2013. And the chart for investment, which is one of the things that we track as well, mirrors this quite closely. And that is that we've had a great increase in investment in clean energy over the last 10 years. And some $2 trillion have already been invested in clean energy assets. So wind farms, solar plants, bioenergy facilities, etc. And for the first time actually in 2013, we went down a little bit by a couple of gigawatts. And that was essentially due to some difficult policy conditions in various parts of the world. And clean energy, has historically always been a very policy-driven market. That's changing, and over the next few years, we actually expect the growth to return. and for new installations to go over 100 gigawatts. Investment has, as I said, mirrored this, but what we're actually seeing and what we've seen in the last 2 years is that investment has gone down even when capacity's gone up. Anyone know why that is? That's right. The unit cost of capacity has fallen. And so that's actually a good thing. So one of the things we do as a company is we get all our analyst teams together around the world and we do long-term detailed forecasting of our markets. So we run a lot of market simulation tools in Australia and in all the major energy markets around the world, and we put together a 2030 market outlook, which is very similar to the IEA's World Energy Outlook, except it's our view. And in that view, we come up with this picture of where the new capacity is going and what it will be. And as you can see, the trends are quite clear that installations for fossil fuels will be declining over time, although we're still going to be building new fossil fuels. But installation of renewable capacity will be strong and continue to accelerate. And in 2013, we're nearly neck and neck in terms of the amount of gigawatts going in on either category of technology, and then renewables clearly have the upper hand. And I mean, in 2030, we're looking at nearly 4 times or thereabouts as much clean energy capacity as fossil fuel capacity that's being installed. Now, for the solar industry, that's particularly good news because it means strong and consistent growth in global installations, and you can see there it's a pretty bright future. In 2010, we had about 18 gigawatts of new capacity installed, and towards 2030, we're looking at 146. Right, so continued strong growth for solar, and that comes in all sorts of forms. That comes in large scale, your utility scale, large facilities, and also obviously on the rooftop. And interestingly, actually, that rooftop segment is about half of the market or a little over in our projections. And that's mainly, of course, due to the economics. It's a technology that works and is cost effective in many markets, including Australia already. So what's driving that growth? Right. So as I said, clean energy has historically been a very policy-driven market. But what is going to drive that in future is economics. And that's obviously where everyone wants to be, where you're not dependent on governments. And as we've seen, our current experience is that governments of different flavours have different opinions, and also that governments are notorious at changing their mind. If you're going to base an industry on government, you're always going to be someone with a lot of heartache. So we want to get to that stage where it's the economics that drive this industry, and we are already there in many markets. So in Australia, if you were to need new electricity generation today on a large scale, which we don't, but if we did, the first point of call would be wind, because wind can produce energy on a per megawatt hour basis. The levelized cost of wind energy is actually cheaper than building a new coal-fired power station. And that's some research we released 2 years ago. And that's quite a remarkable fact, with the whole internal dialogue that goes on in Australia about, the coal and this perception that coal is so cheap whilst renewables are so expensive. Actually is not true in developed countries anymore. And that's largely because the people who are going to put money into those technologies are very aware of the risk. The risk that a new coal-fired power station poses to them as an investor in terms of policy risk. Right, the framework may change, and obviously, carbon is the biggest thing there. But also, importantly, the reputational risk to the institution. So, who wants to be the bank that is investing in a new coal-fired power station and has Greenpeace and GetUp picketing outside their door? Very bad for that institution's reputation, and also a whole host of other risks, such as market risk, which is very prevalent in the Australian energy sector right now. Volatile energy prices, coal power stations over the last 10 years have actually performed pretty badly for many of the banks and investors who put money into them. And then also, what largely is forgotten is that actually coal is a very expensive technology as well, just because of the sheer size, and now the various complexities that need to be on those plants for emissions control, for particulate control, etc. So coal is nowhere near as cheap as the perception is that exists, and we see that phenomena throughout the developed world actually. So you can see wind and solar are competitive with fossil fuels in the United States. In Latin America, actually, we've seen very stark evidence of that, where solar has recently, just in a Brazilian auction, come in at about $80 a megawatt hour, which is US dollars a megawatt hour, which is an extremely low price. Some questions about whether those projects will be viable, but that's where we first started to see really low prices for wind too. And then we can see, in the Middle East, in Africa, in Asia as well, in India, the cheapest thing to build is wind, it's not coal. Huge supply problems getting coal in India, and even in China as well, in certain circumstances and geographies. So it's really the economics that are driving that. And that little flame thing is geothermal, actually. So geothermal as well is price competitive in many markets. So this is the detail. This chart here is the levelized cost of electricity, and hopefully you all know what that is. That's a way of comparing what the cost for generating each unit or megawatt hour of electricity is. We calculate this in a very different way to most governments or academic institutions, in that we don't make assumptions about one of the most important elements, which is financing costs. In a lot of levelized cost of energy surveys, including what's done, studies, including what's done by the Bureau of Resource and Energy Economics in Australia, they assume things like everything costs 10% to finance, right? So 10% is the cost of debt. But as you know, if you're a bad credit risk and you go for a home loan, you're going to be paying more than Linda, who's probably a good credit risk, right? I hope. So the same applies obviously for energy, and in fact it's more stark that some technologies are high risk, some technologies are low risk, and as I mentioned, fossil fuels are in that high risk category, particularly coal in the developed world. Gas as well is often in a higher risk category because of fuel supply, right? Gas is expensive, you're exposed to volatile market forces, unless you can contract long-term fuel supply. You're very exposed to fluctuations in your input cost. Whilst renewables, of course, no carbon risk, no fuel supply risk, only technology risk really, and policy risk depending on how the project is structured. And so the cost of financing renewables actually tends to be very low in comparison to other technologies. And that's very important because, as again, when you finance a house, about half of the money, if you buy $1 million house, won't get you very far in Sydney today, but if you happen to find a house for $1 million, by the time you pay off that loan, you've paid $1 million towards the principal of that house and $1 million in interest costs. So financing is a huge component of levelized cost. So we can see here the range, and if we filter out the noise of the technologies that are kind of minor, we can see the fossil fuels and the conventional technologies at the bottom, wind and PV in the bars at the top, and you can see that they are price competitive, if not lower cost than many of the fossil fuel technologies in many different geographies. So now let's apply this and let's take this forward and say, okay, where is the global energy system going? So we know that a lot of the capacity that's coming into the system is renewables. So right now, globally, about 78% of our electricity is provided from fossil fuels and 22% is renewables. Let's look how this evolves through time. So you can see total supply of electricity is rising as populations grow, as economies grow, as there's increasing electrification. And most of that growth is being met by renewables, a good part. But the thing to really see here and notice, although the proportion of fossil generation has gone down to 65% because the pie has grown, that black bar at the bottom hardly changes. It's the same. more or less. As is, well, the grey bar of gas-fired generation actually increases. And so fundamentally, from an emissions perspective, we're going to be in about the same place in 2030 as we are today on current projections, right? And we know we have to make very deep cuts in emissions right now because we're already doing a terrible job, and we're well behind in our carbon budget. And on current projections, even though we're getting this fantastic growth in renewable capacity, we're pretty much in the same position from an emissions perspective because the coal sticks around. Now, if we look at Australia, it's very, very much the same picture. And I call that the coal conundrum. So by 2020, even though we've got an energy market right now in Australia which is very oversupplied, demand has been low and falling. There's too much capacity out there, and prices on the generation, the wholesale electricity market are very low. Despite that, we're only likely to see about 2.2 gigawatts of coal retire by 2030. So this is capacity. So from a capacity perspective, basically no change. Right? And this is the current environment. No carbon price and the government's direct action policy. So we can see basically no change in the makeup of the existing fossil fuel fleet. This is assuming the existing 41 terawatt hour renewable energy target, which, as I hope you know, is the subject of quite some debate. The government and the opposition right now are trying to hammer out a deal as to decide what the level of that target is, with the government wanting to reduce the target because it says because of the problem of oversupply in the energy system. Although there's clearly a lot of ideological positions that are and beliefs that are influencing that position. So growth in renewables, but the coal stays and hangs around. From a generation perspective, again, much the same, right? So gigawatt hours, where does the energy come from? Staying more or less the same. And in fact, you actually see a dip when we had the carbon price, and now it's going back up. And we've already seen that actually in the few months since the carbon pricing mechanism was repealed, or the carbon tax, as it's been the label that is stuck. Emissions have already begun rising in the power sector as coal has a resurgence and gas generation declines, and that's going to continue for a couple of years, and then we may see a tiny trickle down as we get a little bit of coal retirement, tiny bit, and that increase in renewable generation from the RET. But we're still more or less the same. It's only 1 or 2% difference by 2030. So by this you can see that Australia has a continuing and fundamental problem with carbon emissions from the power sector. And that's really at the crux of the whole issue of carbon. And really, if you boil down the public debate, the political debate about carbon in Australia, it's all about coal. It's about what to do with coal, it's how to address this problem, and how to address this problem in the face of an industry which has contributed a lot to our prosperity, but kind of more importantly, an industry which is deeply ingrained in the psyche of the country, right? Of a country that is still, deeply convinced that coal is essential to our prosperity and is the reason why our living standards are good. Et cetera, et cetera. And the mining industry is very good at promoting that line, although the facts can be disputed. But at its heart, we're facing a very, very difficult problem, and we can't come to terms with what we do about coal. So incidentally, as an aside, the government's direct action policy, if you keep up to date with the media, you'll see that it has no expert endorsement apart from its designer. We analysed that policy in detail too. The first part of that policy is called an emissions reduction fund, where they've got a $3.2 billion budget, I think it is, off the top of my head, that is there to buy abatement from the industrial sector, and that basically won't touch power at all, right? It's just the prices were far too low. The minister continuously says we're about cleaning up power stations, etc. It's not going to clean up any power station because the prices are just far, far too low. And the volumes are also very low for what you can achieve. So it will have no impact on the power sector. The government has put a very loose architecture for a baseline and credit scheme, which is another type of carbon market, as phase 2 of that policy. So it is possible that could have some effect and do something, but the government's appetite for putting a robust framework on that, which has a cap on emissions and forces people to buy offsets and inevitably places costs on industry, is very, very questionable. So the likelihood that this will change in the current policy framework is low at the moment. And as I mentioned, the RET. So this is the picture of clean energy investment in Australia, and we track this to the dollar. And you can see that the RET has driven a whole lot of investment, some $20 billion of investment in large-scale renewables since its inception in 2001. And we had a little bit of a dip over here in 2008 when we had an issue of solar, small-scale solar, flooding the market and playing with the fundamentals of the market and damaging the investment environment for large-scale renewables. And then the government fixed that, and we had a huge surge. And then we've had a build-up as the target escalates. And 2014 year to date, we've never seen a more dramatic collapse than what this government has been able to achieve in its rhetoric and its review of the renewable energy target. It's been absolutely devastating for the sector. There's a tiny bit of investment there on the chart, and that's all come from ARENA, or the Clean Energy Finance Corporation. So government bodies, which the current government itself wants to repeal, which have kept dishing out a few grants. So basically, it's completely paralysed the industry, and we're not going to see a return of that until there's probably bipartisan consensus between Labor and Liberal as to how we go forward. So the large-scale renewable energy industry is in a very, very tight spot at the moment. But coming back to the 3 points I gave you at the start, the way we relate to energy is changing. And although the emissions picture is quite depressing, from the point of view that they're just not going to go down on current projections, the but is there are a number of promising developments and drivers in the market that we need to keep a key eye on. And the first of these, which I'm just kind of showing here in some snazzy pictures, is obviously new technologies, right, which are changing the way that consumers relate to energy and are able to access energy. So smart thermostats, there's the Nest thermostat, which has been bought by Google. And in a battle really between Google and Apple for who controls your home energy interface, because they can see that that's going to be a very big market. So smart thermostats and energy efficient appliances that help us to reduce our energy consumption and have better control of it, and really empowering the consumer, are rapidly changing in developed markets. Demand for electricity and also the economics of generating electricity for the industry. The other component of that is, of course, small-scale PV, which all you guys are obviously intimately familiar with, which is again really changing the dynamics of the industry. Obviously, it's giving a lot of people, the ability to be to reduce their consumption and to become independent of the energy provider, and that is a very big threat to the current incumbent utility business model. And what it represents is the fact that consumers now have choice about how they can procure their energy and also at what cost. And that's an unstoppable phenomenon now that's only going to continue. And then we've got a nice picture of a Tesla Model S, which again represents new technologies, innovation in electric vehicles, and we see this in all sorts of other technologies too. And one of the exciting things, of course, is lithium-ion and battery technology, which I'll go into a little bit. But the way consumers are relating to energy the things that they can do is changing and changing rapidly. And that is a huge driver of change, which is very, very difficult to predict in the energy market. And you know, a key example, of course, when technologies change and businesses change very fast, and businesses that don't respond die, of course, is Kodak. You'll all know about the Kodak, you know, that Kodak moment. But also think about mobile phones, right? What's happened to the business model for the fixed telephone line? Who has a fixed telephone line now? Very few of us, right? And if you were going to build one, you know, going into a new house, you almost certainly would not connect one. Just use your mobile. And so that business model has fallen away very fast. And industries have to rapidly change. And we're certainly seeing already the effects of these new technologies. And so, as I said, what that's doing is it's reshaping power demand growth. It's meaning that power demand is declining in many developed countries around the world, which is something that we've never seen before and breaks one of the fundamental rules of the energy system that has been in place for a century, and that is as the economy grows, energy demand grows. And that basic rule is why the Australian energy market operator and the Australian energy industry as a whole has got their outlook for demand so disastrously wrong, and therefore why investment, we've had all this redundant and unnecessary investment in transmission infrastructure, which has, you know, spiraled our electricity costs, is because they thought, okay, no, that rule, that's the golden rule. The economy will grow and electricity demand will grow. But that rule has been broken for the first time because of the technologies and some other factors as well. But the thing is, it's not just an Australian phenomenon. It's happening in Europe, it's happening in the US, Canada, in the Middle East. And the only places where we're seeing strong energy demand growth is in the developing world, where that GDP and energy demand correlation makes more sense because you're actually bringing people on to consume electricity that hadn't consumed before, or giving them appliances and things that they never had access to before. So one of the other exciting things now, I trust that all of you will be very familiar with the PV experience curve. You're all part of that experience curve, and one of the biggest contributors to that experience curve and the R&D that happens here, and the sheer amount of records that UNSW has helped to break. But there's a very similar experience curve exhibited in lithium-ion battery technology. And we track this. We have a battery price index. We survey manufacturers, there's not many of them, and find out, what are they selling their batteries for. And as volume goes up, more batteries are sold, unit costs will come down. And this is our projection at the moment. It's more conservative than others out there. But essentially what that means is that in about 2015-16, electric vehicles we're projecting will be competitive on cost with an efficient petrol vehicle. So your Nissan Leaf will outperform your Mitsubishi Lancer. And that, again, has potentially big consequences for the global petroleum industry if people start to make a rational consumer choice. And what we see, of course, is that if you market the product correctly, it's still a sexy car. It's not a hippie greeny thing. People want to buy it. People want to buy a Tesla because it's a great product. And so we're going to see those things continue to change vehicle composition. And again, that the way consumer goods are taken up is very, very difficult to predict. And we've seen that first-hand experience in the Australian solar industry, right? Any forecast about PV deployment in Australia, about how much small-scale PV people will buy, has been disastrously wrong, completely wrong. We were the most bullish by far, and even we were wrong. Because what consumers do is inherently irrational and very, very, very difficult to predict. Because they make decisions for all sorts of reasons, because my neighbour has it, because I want to do something nice for the environment, because I hate my energy company, and I don't care if it costs me a little more, I just don't want to pay them. All these sorts of things. And the same thing, electric vehicles, very hard to predict which way it'll go. And of course, the other thing is that as vehicle deployment drives scale in the industry, all of a sudden you're getting into economic competitiveness at the home, at storing energy. We're figuring out the economics of that right now. and when they'll plug in. So you can obviously charge your batteries and drain them. Charge your batteries using PV and drain them during the peak price at night, and it opens up huge new avenues for the industry. One of the other things that's very interesting and needs to be closely watched is the fossil fuel divestment movement. I'm disappointed to say that UNSW did not chose to say that it was a political, it was a politically driven thing and it didn't want to participate. This is about risk for financial institutions. As I said at the beginning, coal has become a risky investment. If you look at the equity performance of coal companies around the world, particularly in the US, they are terrible. Their equity valuations, the share market price of them has halved, quartered, tumbled as demand for coal has collapsed in the US. The spot price of coal has come down. Of course, spot prices are dictated by all sorts of things. But the value has come off coal at the moment, and it inherently faces an uncertain future because of the changes that are afoot on the technology side, obviously because of emissions policy and the like. But it's full of risk. And serious companies are thinking very seriously about, do I want to be involved? Do I want to put my money into coal and extractive industries? And what is my preparedness for if and when things rapidly change? So we've seen, BHP has announced, it's looked very closely at the world's biggest mining company at its exposure to coal and what happens in a low carbon world and whether that company continues to perform or not. And shareholders are demanding, rightly so, that companies assess that risk because things are hard to predict. They change quickly. And as I'll show you, we are terrible at predicting them. So really this is about risk. And one of the things, of course, again, this is a people movement. And these things happen very fast and change rapidly. So it started in university campuses, as did the divestment movement from apartheid South Africa. Right? It was a very, very similar pattern. Student activists would lobby the university, divest. And then eventually, they would say, no. Then eventually one fell, and then the dominoes start falling. And the fossil fuel industry is watching this closely and is frankly scared, and rightly so. And we can see that actually in the disproportionate and somewhat hysterical reaction to ANU's new investment strategy and divesting from a number of companies. Completely disproportional. The Australian Financial Review frankly running a campaign like the Murdoch press often does, with editorials slamming the university, with constantly publishing articles, against it, criticising it, etc. Obviously some questions can rightly be asked about the way in which ANU did it, but they're clearly very concerned about the momentum that's building. Now, one of the most interesting things actually, and indications that this is serious, is that FTSE, which is the world's biggest exchange in the US, and BlackRock, which is the world's biggest asset manager with, I think, some $500 billion of capital under management, assets under management, have just announced a couple of months ago that they will partner to have a fossil fuels excluded fund, right? So like an S&P 200 excluding fossil fuels. And BlackRock will run a fund that allows people to invest in that, right? So now there are real world Wall Street mechanisms available for a company that is worried about risk or diversifying away from fossil fuel risk, in particular coal risk, to say, okay, I'm going to put my money in that fund, or put a little bit of money in that fund to help manage risk and portfolio risk. So it's actually a big driver of, it could potentially be a very big driver of change. And the other, of course, is pollution, right? Many of you will know, a lot of you probably have a lot of contact with China, and China's cities are unlivable. Staff members of our own in our Beijing office have left, taken other jobs because they wanted to escape the pollution. Right? The cities are frankly unlivable. There are riots on the streets of Chinese cities because the issues are so bad. And the main contributor is coal for power generation, but also coal for domestic purposes. And it just kind of underscores the fact that there are better ways to generate electricity now that are less harmful to people and have greater acceptance. And China is very serious about combating this problem, and they rightly should be when your cities are becoming unlivable. LA had a similar problem to do with vehicle emissions in the 70s and 80s, which bore the US Clean Air Act, and China has to tackle this problem with a similar similar seriousness and become similarly effective. And in our projections, we can see actually that although the story is always told about China building a new coal-fired power station every week and opening one, yes, they've opened and commissioned a phenomenal amount of new coal, but in 2013 they actually built more renewables. There was more renewable capacity built than fossil, and China will continue to build coal throughout this decade on these projections, but by 2030. They will actually be removing more coal than they build. They'll be retiring more of the really inefficient plants while still building some efficient ones. But they'll be net negative coal while still building a lot of renewables. So China is undoubtedly changing what their power sector looks like. And one of the other big potential game changers, now you probably continuously hear the line about resource companies and the government and others saying that, look, demand for coal in Asia, in India, in China is insatiable. Where the Australian public have really been sold that line. And again, I would caution that that's full of risk. That projection is full of risk. And basing an economic strategy on that doesn't sound particularly sound to me. But one of the big game changers is gas. Now, we know what gas has done for the American power system, right? The Americans have managed to extract shale gas. It's got other environmental issues and community acceptance issues, etc., but it has completely changed their energy system. The US has been on a trajectory of lowering emissions purely because of gas. The most significant factor being gas, and it has forced a huge amount of coal retirements and will continue to force them just because coal can't compete with the cheap gas in the US. But the US doesn't have the biggest reserves of gas in the world. They are in China. And the question is, at what cost can the Chinese extract that shale gas? They're just starting, the early stage. There's many differences to the geology and the technicalities of extracting it from the US, so you can't one for one translate it's cheap to do in the US, it's going to be cheap to do in China. But if they do it cheaply, that will completely change the Chinese energy system. And China will run towards gas generation, gas for power generation, to help rid themselves of the terrible air pollution problems they're facing. And that's a big unknown. Very early days, but could be a huge game changer. So this graph here shows what the IEA, International Energy Agency, predicted would be renewable energy capacity additions in 2000 up until 2020. And every year they've updated this as they do in their World Energy Outlook, and look what happens. Very, very hard to predict. Renewable costs have changed so much, policy mechanisms have been have been deployed in a wider scale than people had predicted. And people, frankly, got the economics of renewables completely wrong, and they continue to do so, continue to underestimate the pace of innovation and the pace of change when we're talking about technologies, and are hopelessly wrong at forecasting what happens. We too have been wrong, although our projections are always more bullish because we like to think at least that we understand the economics of renewables much better. And our research is the basis of many agencies and companies' understanding of renewable technology costs and the economics of the energy system. But they're very, very hard to predict, very hard. And I'll leave you my talk with this kind of example which crystallizes it all, and the way that innovation and new technology transforms industries and destroys existing businesses. So this is newspaper revenue in the United States from 1950 to 2000, and probably 8 there. In 1982, the internet was invented at Stanford Uni and the US military. And people in the boards of newspapers would have just thought, okay, a cool R&D project. Probably didn't get much attention. 1992, the browser came about, and again, probably wouldn't think that much of it. Well, there's this thing, so you can access a few websites. Nerds can share information. In 1997, the smartphone was invented, and in the board of newspapers, perhaps they started saying, okay, well, yeah. There's a new technology. Probably weren't thinking about a new platform for distribution of information. And in 2006 came Twitter. And the other thing we should overlay on this actually is Google AdWords. And look what's happened to newspaper advertising revenue since, right? The media industry, the newspaper, who get most of their revenue from ads and classifieds and etc. has completely collapsed because the medium is in decline. It's gone to the internet. It's gone to Google AdWords. It's gone to social media. Circulation's completely changed. Newspapers have been completely wrong-footed, and we can see this same pattern in many different industries, right? Telcos, digital photography, all sorts of things. It took 24 years between the invention of the internet and the founding of Twitter and the real uptake of Google AdWords for the newspaper industry to go from, constant increases in revenue to near fatal collapse. And through that time, they probably didn't notice, right? As the momentum built. Am I saying it's going to be 24 years between the invention of the solar panel? Well, it's been more than that, anyway. No, but the point is that it's like the physical change of state in property, in steam, or in a molecule. There's a fundamental change in the state of things, and it happens very fast, and it happens in a way we can't predict, and it happens in time frames where we have no idea. And that's what is likely to happen in the energy system. And really, from an emissions perspective, that's all we can really hope for, is that the charts I showed at the beginning don't end up being what eventuates. So with that, that's my wrap. It's just to say, don't copy our stuff. And here's my email address and Twitter handle if you have any questions. Okay, happy to take any questions now if you have any.
Have you done those graphs with the phase change? Your projections of what coal looks like. Can you give us a bit more optimistic outlook?
As I said, too hard to predict. So many different forces at play. Yeah, it's very, very hard to predict. Look, at the moment we think that China will reach peak coal in about 2020 or earlier. And we're looking very carefully about the recent moves, which have really kind of shocked the industry. Introduction of tariffs, that may be just a a tariff negotiation play, the quality restrictions, that may be just efforts to prop up the domestic industry as well. But it's a clear sign that Beijing is changing things and making significant changes. And yeah, as I said, there's just so many forces at play. It's just too difficult to predict. That's why I say it's fraught with risk.
Early on in your presentation, you showed levelised cost of electricity, and I'm just interested to understand a bit more the differences in the coal levelised cost of electricity between the different countries. It's quite interesting because Australia was more expensive than some of the other.
Yeah, that's right. Is it going to work? Let's do this. A lot of animation slides. Sorry, this will take a little while. That's how you do these pretty animations. You just make a lot of slides. There we go. So yeah, big range. I mean, there's a big range in all technologies, frankly, based on geography, primarily, and the different conditions that are underway there. I mean, look, coal in China is still cheap, right? Because they don't. It's still a mainstream industry. They don't really have the same considerations about risk and etc. And a lot of it's government-backed finance. Labour is cheap. All the usual things that make China cheap and Asia cheap. Australia is up the top of this ranking, despite having so much indigenous coal, for a number of factors. One, it's probably just that my team is the best at doing this. At coal, we actually pioneered this technique in our office, just like UNSW, we're pioneers. It's new build, yes. LCO is all new build. But some of the factors are, the fuel is cheap, but it's not as cheap as people think, and it's not as cheap as the existing contracts, right? Because the economics are that existing coal-fired power stations tend to be supplied by an existing coal mine, which is isolated from the export market, or has a very long contract, right? So it's not subject to the same global forces. But if you were to have to build a new coal mine, then you actually have to pay the international price of coal. A couple of years ago that was high, that's now low, but it's subject to risk, right? That changes a lot. And interestingly, if you recall when the New South Wales Labor government did its botched privatisation, the only way they could offload a coal generator was to promise they'd build a new coal mine at a $1 billion cost to the taxpayer. It was a scandal in my mind. But it just goes to show that the cost of fuel is actually quite a concern and very variable. And the other factor is the financing costs. We get a very good handle on it because we actually survey all the banks. We ring up the heads of project finance of all the big four and we say, what would you do? How would you finance? What would be the structure for wind and coal, etc.? And this is also assuming a carbon price actually is in there. So without that, it's closer to 100. But yeah, it's quite high.
With your insight for phase change of previous markets that have collapsed, what can you say about how the established infrastructure and large coal companies might react compared to how, say, newspaper companies have reacted to the declining market?
That Gandhi had a saying, let me get it right. First they ignore you, then they laugh at you, then they fight you, then you win. And we've kind of seen those various phases, right? The ignore you's definitely happened, then the laugh at you has happened. Now the fight at you is on. And that really characterises the reaction. I mean, the reaction to the ANU divestment thing is clear fight. The reaction to the carbon price is clear fight. To the various forces at play, is fight/denialism. But the more savvy companies are considering and evaluating risk very hard, as would more savvy technology companies, media companies. Just look at the difference between Nokia and Samsung, or Nokia kind of ignored the smartphone, Samsung embraced it, or other makers. so you just have a whole variety of reactions. Your pure play coal company is almost squarely in the fight camp. Your diversified resource company is in the carefully assessed camp, broadly speaking. So that's why we've seen the likes of BHP carefully assess and consider, and make sure that even if their coal mines go bad, actually most of their revenue is from other commodities, which will actually boom. Iron ore, and other metal commodities will actually be very, very strong in a high climate action world. So yeah, they consider a lot. So it really depends. Yeah, but definitely, I think that phase is very true. Going this phase, yeah.
Thanks very much. One of the issues that you've covered the supply side of energy, and you mentioned energy efficiency briefly, but no detailed analysis. And I guess in terms of energy predictions, I think one of the things that's probably underanalyzed and underappreciated is the impact of high energy prices and the impact of more energy efficiency. And I think that if you looked at, say, 2008, you mentioned decrease in emissions due to carbon price. Well, that's 2 cents a kilowatt hour or something, whereas we've seen 15% increase for 3-4 years around 2008 onwards that drove electricity higher. And what the reaction was in the market was for people to use less energy.
Yeah.
And I think that's, if you want to sharpen predictions, I think the International Energy Agency's predictions, they're 450 or whatever ppm scenario looks at energy efficiency as being the biggest, the cheapest and the quickest way to reduce emissions. So I think I would encourage analysts such as yourselves to consider energy efficiency, because otherwise we're buying the line of onwards and upwards, which is what our coal and natural gas and oil brethren would have us believe is the only way forward.
That's definitely right. And one of the tricky things is that it's very difficult, again, to predict, because it's a consumer good, essentially, and you're looking at consumer reactions. So we've actually just done some detailed work on Australia, at looking at the market operators' latest forecast and very carefully looking at energy efficiency, because the single biggest driver of why Australia's energy demand has gone down has actually been energy efficiency. Lots of people like to say it's because of industrial closures. That's actually a smaller component than energy efficiency. And yes, a lot of that was price response. But equally, I think it is just media and consciousness response, right? So, if we had the introduction of a carbon price without the fraught political circumstances and the phenomenal backlash, etc., it probably wouldn't be as high, because it wasn't in everyone's consciousness, right? And for behaviour to change, it really needs to be in your consciousness. And that's another thing as well. People have always assumed that demand for electricity is inelastic, right? As they say it is with petrol. And in the short term, that tends to be true. And that the price goes up bad, like you still got to drive your car. But in the long term, it drives change. More efficient engines, etc. We've seen that, and those things are, again, very hard to predict, and it's hard to tell. Is that it's obviously been a systemic change, but is it a long-lasting systemic change? Or now that carbon prices are gone, electricity prices are going to moderate a bit, will people say, I'm not so worried about it anymore, let me plug that second beer fridge in, or let me run my heater against my air conditioner and see who wins. They're hard to predict, yeah. But definitely accept your point there. Yeah. No.
So just related to that, so when the Australian energy market talks about demand dropping, a lot of it is energy efficiency. They don't include the behind the meter demand, do they? Or do they?
Behind the meter supply? From PV? Yeah.
Because that's the total energy demand in Australia.
Yes, yeah.
Because they're also using electricity, even though it's not supplied by the electricity market.
Yeah. No, they do.
So it's kind of an artificial drop in demand. There's still demand there, but it's being supplied from elsewhere.
Yes and no. So, they do what's called a net forecast and a gross forecast, which is kind of grid supplied and then total produced. Even if you were to do the gross forecast and put the PV generation on, we still get a decline, because energy efficiency has been a bigger factor than PV generation. And you have all the other factors which have also reduced demand. But that's one of the things as well. That's one of the reasons why AEMO keep getting their demand forecast wrong, is because their PV projections are continually wrong and underestimated. And again, like I said, everyone got that very wrong. Some are more wrong than others. And AEMO is actually, tended to be in the conservative camp, so they've been on that kind of more wrong than other side, more often than not.
On this point again, this decoupling of growth and demand that you say is being mirrored around the world, is the particular set of things that happen in Australia replicated anywhere else, or are there factors locally?
The energy efficiency, yes. The PV uptake, yes. I'm not really sure about the price elasticity. It's been confused in the US and Europe. Demand has declined, but their economies actually have sagged. So Australia has been the clearest and most potent signal of that. GDP goes like that, and demand is now going like this. So some of the drivers are very similar.
I was just curious to understand if you've done any forecasting on how you anticipate the Australian energy market might transform beyond the supply side. So 20 years from now, do you think Gen Taylors is still going to dominate energy supply and that business model will live on, or do you see a transition to more decentralised systems and given the complex structure of generation, transmission, distribution and retailing, how do you sort of see that playing out?
Yeah, that's a good question. I mean, we don't forecast that. Forecasting that would be like forecasting politics. Impossible and pointless. But there's definitely going to be a lot more decentralised energy. So we do a lot of small-scale PV forecasting, where we try and take into account the behavioural factors as much as possible. And our forecast is for there to be about 20 gigawatts of small-scale PV by 2030. Right now we're about 3. So continued strong uptake. And remember, I told you we've been the most bullish out there. We still are the most bullish, but we've also been wrong, underestimated. So I'd say the risk is on the upside. And what happens to the utility business model? Big question. We're grappling with that, as is everyone else around the world, of trying to figure out what happens and observing what people are doing. It's safe to say nobody has come up with a coherent strategy yet. It is an existential threat to the utility business model, and also, I mean, it's just there's even the wholesale energy market with is with the flooding of renewables into the system causes all sorts of problems, lots of questions about market design. How do you have an efficient economic system when fuel is free? All sorts of things, lots of different things to grapple with, and nobody really knows where it's going to go, who the casualties will be, who's evolving. Of the Australian companies, look, I can tell you that all the energy retailers, the big 3, are looking and thinking about it closely. So, look, broadly speaking, I'd say their strategy is defend to buy time, right? So all of them have rallied against the RET in order to try and kind of protect their existing asset base, but they are buying time whilst they think about how do we transition that, how do we survive in a new reality, etc. I don't know whether they're really doing a good job or not. Watching very closely.
So in your predictions to 2030 on Australian energy supply, it's very convenient to show coal as being steady, isn't it, really? Because you're showing, 20-30% growth in energy demand. If we didn't assume growth, then we'd like to see, we'd expect to see coal going down. It seems too convenient that coal's just staying steady at the moment.
Yeah. Well, look, there are a couple of factors at play. Let's assume electricity demand was flat and the RET stayed as is, then yes, you would force.
Only changes what that looks like.
You would force some of the coal out, but you first force the gas out because the gas is more expensive, and the funny thing is that even if you retire some coal, so even though, I said 3 gigawatts, 2.2 gigawatts of coal exits the system over this period of time, but generation doesn't actually really change. That's because even if old, inefficient plants, expensive plants exit, the other plants just up their utilisation. So total generation stays about the same. So that's one of the reasons why actually, this idea that the government should go and retire a plant, that government should pay Hazelwood to close, or pay a dirty old brand coal to close, won't actually achieve any abatement. It's non-additional abatement, because the government will pay $1 or $2 billion, and then the other generators will just up and make hay. So it makes no economic sense. It's one of the reasons why the Gillard government abandoned the contracts for closure program. So yeah, I mean, the bottom line is it is very difficult to force these assets out, because they're depreciated, they're old, they do produce very cheap on their existing arrangements. It's like your old Commodore. It's way better to go and buy a hybrid Camry, but you've sunk the money on the Commodore. You're going to keep driving it if it gets you around, even if the unit cost is a bit higher, or in reality it's actually a bit lower. So that's why you really need market-based intervention to get to force retirements. So you need a high carbon price, basically, or the government has to pay a huge amount of money to close a lot of power stations, enough that they can't up their utilisation and do any more, or it needs to force them out by forcing more renewables in, and then you get the screams of protest that happen. So it's a very difficult, it's a difficult and it's a fraught policy space, right? How do you tell someone who's put money in, who's got a right of return on their asset, that no, we're going to introduce policy measures that disadvantage you, close you down, etc. It's tough. But we've failed. We've conclusively failed. Yeah.
So that's the Australian perspective, but you've painted a slightly different picture in the States, where the shale gas was now pushing out the coal. Yeah. And the possibility, you talk about the possibility of that happening in China. And that's also been the reason for the drop in emissions in the US, and that could happen in China, and that seemed to be pretty optimistic. But that, as I understand it, still doesn't get us anywhere near where we need to be in terms of emissions. So if we're relying on gas to come through and take over the huge emitting countries, what's the next step from there? Do we expect that renewables will eventually catch up and push out gas, or is that still a dream? Do we really need that intervention, that political intervention?
It depends how fast, right? So in the long term, yes, renewables will push out. On current projections, as I said, these things change faster, so it will probably happen sooner than anyone thinks. So I mean, what's happened in the US, why the gas has pushed out the coal, is that the gas has become cheaper than the coal, so the coal has become too expensive to run. It's undermined economically. So basically, you need to get to a stage where the new entrant cost of new renewables is lower than the running cost of coal. So right, so even on a new entrant cost, right, cost to build and supply energy from a new plant, right, wind is about $80 right now for best in class. Coal's about 100, so wind's ahead. But existing coal produces for about $30. So we need renewables to get down to $30 before they push these out, and that's the real challenge. And that's why if you're going to achieve that in any time in the next 10, 20 years, in all likelihood, you need policy intervention. And the reason why gas, our gas prices are spiralling, because we're now exporting it to Japan, where it's triple the cost, and so gas is going down, not up.
So just to pick up on that point, small-scale solar and efficiency of buildings is way cheaper, because you're not dealing with wholesale, you're dealing with retail.
That's right. Yeah.
So any discussions where we just simply focus on the wholesale price of electricity is distracting us from where the action will take place in retail. And I think the scenarios that ignore the potential for energy efficiency and distributed solar to eat the heart out of the existing power industry is missing the point. So I think we really just need to take into account the fact that small, nimble, fast responses of energy efficiency and distributed solar will be like small-scale portable computing taking over from mainframes, or mobiles taking over from landlines, as you say. So I think they're the ones to look at. if PV or wind can get down to 30 cents, $30 an megawatt hour. If solar gets anywhere near like that, then everyone's going to be putting solar on rooftops, if there's any rooftops left. I'll probably face them south or away from the equator. Because it'll be so bloody cheap that you'll be offsetting 25 cents northwards of retail.
And as you say, that could well happen. I mean, this projection is taking our own view of, so we're assuming more energy efficiency than AMO did. This was an old projection actually, a newer one will be flatter. But yeah, I mean, if this continues to go down, you're right, definitely. But it's not going to go down to 100% anytime soon, most likely. Right? Because
I think there's going to be a transition away from fossil fuels. PV and efficiency is cheaper than anything, and I think customers will respond to high electricity and high energy prices. If Australian gas prices stay where they are, gas is now for residential customers at 15 cents a kilowatt hour, whereas it used to be 7 or 8. So PV on the rooftop is now cheaper than gas. And being efficient is typically cheaper. So I think there's a lot of other players that can undermine the fossil fuel investment.
That's true.
Have you done a scenario with a carbon price, and what's your view of future carbon price up to 2030? In the short term, yes, there'll be no carbon price probably for the next couple of years. Looking out for the next 15 to 20 years, it's quite difficult to see a future with no carbon price if you want to reduce emissions.
That's right, yeah. I mean, I totally agree. And when we survey our clients and things and say, who are the, emissions and regulatory managers at coal-fired power stations like, do you think there'll be a carbon price in 2020? They all say yes. So yeah, it's inconceivable that the irrationality of the debate will continue forever. It'll happen at some point in time. The trick with Australia, the difficult thing, is that in order to have a carbon price high enough to change this, to really affect the mix of generation in the power sector, it needs to be really, really high. Because Australia has expensive, it's hard, that's so cheap, that existing base, that you need a $50, $60 carbon price to really push them out. And that's unpalatably high. So we're always going to have a carbon market that's linked to another market which lowers the price, which means that we don't achieve a whole lot of abatement at home, unless the economics radically change. So that's kind of our outlook. So yeah, I mean, if the carbon pricing mechanism stayed in place, we had more retirements, we had lower emissions overall because your more efficient plants run harder and your least efficient plants turn off. So you get this optimization. But you don't get dramatic change. The carbon price needs to be too high to do that. Don't know how we're running for time, are we? See if we. Well, they haven't beat down the door yet. Sure.
Do you have any idea when the existing coal contracts are running out, or the coal mines might be no longer producing in order to maintain these prices?
Yeah, well, actually, a whole bunch of them rolled off over the last few years and have been restruck. And if that were to be restruck in the current environment where spot prices are actually really low, you'd actually be probably in better economic shape. Yeah.
The solar firm represents a small portion even in the projection for 2030. Any reason behind that?
Solar thermal, it's just outgunned by PV. Very expensive. Starting to lose people, I should wrap up. Yeah, it's very expensive. It doesn't have the dynamics that the PV market has, that the modularity, the decreasing costs, etc. Yeah.
One very quick one. On your newspaper revenue slide, what was the event that triggered the sustained decline in revenue? There was a post-Twitter clip.
Yeah.
What was that?
Which one's that?
I think the arrows just went at the same place. That's all.
The arrows had a phase shift.
Yeah, right. That's probably a copy-paste problem.
So that was Twitter.
Yeah, that's Twitter. I mean, the thing, it's not just Twitter. Twitter's a nice example. It's probably more Google AdWords. It's Google.
There was low on digital versions as well. which is cannibalizing the printed versions.
Yeah, the digital versions.
All right, I think we better wrap up. All right, thank you very much, Emma.